Every day, headlines warn us recession fears are rising. Stock markets in turmoil. Banks facing instability. It's alarming, but is it just media hype, or are we truly heading toward a financial meltdown? History shows that most people don't recognize a crisis until it's too late. The 2008 crash wiped out millions of jobs overnight. In 2020, businesses shut down globally within weeks. Are we next? The warning signs are already here. Let's break down the biggest red flags, and more importantly, what you need to do now to protect yourself before it's too late. 1. Surging inflation, the silent wealth killer. Have you noticed your paycheck doesn't stretch as far? That's inflation, a silent thief making everything more expensive while your money loses value. Gas prices have soared. Groceries that cost $50 a year ago now cost $75. Rent in major cities has jumped 30–50%. The government says inflation is cooling, but are your bills actually lower? If not, inflation is still eroding your purchasing power. Why it's dangerous? Your savings shrink, living costs rise, and if wages don't keep up, you're effectively getting poorer. What you can do: invest in assets that hedge against inflation. Gold, stocks, real estate. Cut unnecessary expenses before prices rise further. And most importantly, increase your income, because saving alone won't protect you. 2. Rising interest rates. The cost of borrowing is skyrocketing. A few years ago, buying a house with a low-interest loan seemed like a great idea. Now, mortgage rates have shot past 7%, the highest in decades. Credit card APRs are above 20%. Auto loans are at record highs. Borrowing money has never been this expensive. When interest rates rise, businesses borrow less, consumers spend less, and the economy slows down. We've already seen home sales drop significantly. More people are holding off on big purchases. Why this is dangerous? A slow housing market affects construction jobs, real estate values, and consumer confidence. High borrowing costs force businesses to cut back, leading to job losses. What you can do: if you have credit card debt, pay it off ASAP before rates climb higher. If you're considering buying a home, lock in a fixed-rate mortgage now before it becomes even more unaffordable. 3. Stock market volatility. The calm before the storm? One day, the stock market is up. The next, it's plunging. While fluctuations are normal, extreme volatility is often a red flag. Investors are pulling their money into safe assets like gold and bonds, which signals fear in the market. Remember 2008? The stock market crashed before the housing crisis fully unfolded. In 2020, the market dropped nearly 30% in just a few weeks. Stock market turmoil often precedes bigger economic shocks. Why this is dangerous? When markets crash, companies struggle to raise money, leading to layoffs and cost-cutting. Investors panic sell, pushing the economy further into recession. What you can do: don't panic sell. Diversify your investments. Don't put all your money in one stock or even one asset class. And if you see strong companies at discounted prices, this could be a rare opportunity to invest while others are fearful. 4. Mass layoffs and hiring freezes. The job market is cracking. Tech giants like Amazon, Google, and Meta have laid off over 100,000 employees in the past year. Major retailers are closing stores. Small businesses are shutting down at an alarming rate. Why this is dangerous? Job losses ripple through the economy. When people stop spending, businesses make less money, leading to even more layoffs. It's a vicious cycle that can spiral into a full-blown recession. What you can do: start preparing before layoffs hit. Build an emergency fund. Develop skills that are recession-proof. AI, cybersecurity, healthcare, and finance are all fields that tend to survive economic downturns. And don't rely on just one income stream. Side hustles. Number 5. Bank failures. Can you trust your money is safe? Remember Silicon Valley Bank's collapse in 2023? It was one of the largest bank failures since 2008, and it exposed serious cracks in the financial system. If one major bank can collapse, what's stopping others? Why this is dangerous? When banks fail, depositors panic, leading to more instability. If multiple banks collapse, the entire financial system can go into crisis mode. What you can do: don't keep all your money in one bank. Make sure your deposits are within FDIC insurance limits, $250,000 per depositor per bank. Consider diversifying your savings across multiple banks and investment options. 6. Government debt is exploding. Can the U.S. keep up? The U.S. national debt has surpassed 34 trillion and is still climbing. This means the government is spending more than it collects in revenue. Why this is dangerous? Excessive debt can lead to higher taxes, spending cuts, and inflation. As interest payments on the debt rise, it could crowd out funding for essential programs like So Don't Rely on Government Support. Invest in tangible assets like real estate, commodities, and gold to hedge against inflation and economic instability. Final thoughts: be prepared, not scared. Here's the hard truth. The warning signs are already here. Inflation is eating away at wealth. Borrowing is becoming impossible. Layoffs are increasing, and financial institutions are under stress. The people who see it coming and prepare now will be the ones who survive, and even thrive, while everyone else panics. What can you do today? Increase your income. Find ways to make money outside of your 9-to-5 job. Diversify your investments. Stocks, gold, real estate, and digital assets can hedge against risk. Build an emergency fund. Aim for at least 6 months of expenses saved. Stay informed. Economic shifts happen fast. Don't be caught off guard. Which warning sign concerns you the most? Drop your thoughts in the comments. If this video helped you, share, and subscribe for more insights on protecting your financial future.